Hey everybody. So in this video we're going to be discussing the LIFO method of inventory. So what we hope to accomplish here is give you a little bit of background about what LIFO is. We're then going to move on to a sample problem and we're going to calculate out LIFO under both the periodic inventory system as well as the perpetual inventory system. And then from there we're going to go in and we're going to compare the cost of goods sold and ending inventory under both of those inventory methods. So first, what is LIFO? So LIFO stands for last in, first out. And so what that means is the most recent inventory items that you purchase or make are the first to be sold. So it's the exact opposite from the FIFO method of inventory, where under the FIFO method, the first items, so the oldest items, are the ones to be sold. So LIFO, last in, first out, the latest goods are the first to be sold, and the oldest or first items of inventory that were purchased are the last to be sold. One of the benefits under the LIFO method is that it matches your most recent inventory purchases with your most recent sales. So in accounting, we like to follow the concept of the matching principle, and the LIFO method of inventory does that pretty well in terms of matching, current sales prices with current inventory prices. Under the LIFO method, net income tends to be less in times of rising prices because as prices go up, your net income goes down because your cost of goods sold is higher, and cost of goods sold being an expense makes your net income lower. And when your net income is lower, that tends to lower your tax bill at the end of the year because your taxable income is also lower. So one of the downsides to LIFO is that the inventory balance that you show on your balance sheet may not accurately reflect current prices. So if you have really slow moving inventory, you might have items that were purchased or made a long time ago that are still sitting there because under the LIFO method, those first items or the oldest items are sold last. So when you run a balance sheet, that inventory may not be properly may not accurately reflect your current inventory prices that's out there in the marketplace. So let's take a look at a sample problem. So if you watch my video on the FIFO inventory method, you know that when I approach these types of problems, I like to set them up using buckets. And each bucket represents each lot of inventory or each group of inventory that was purchased on a specific date at a specific price. That way it helps me keep everything straight when I need to go in and calculate out my ending inventory and my cost of goods sold. So let's take a look at the first question here. So calculate the cost of goods sold and the value of ending inventory under the LIFO method using the periodic inventory system. Assume there was no beginning inventory prior to March 1st and a physical count of inventory at the end of the month was 30 units. So in order to figure out our cost of goods sold, we have to start with our beginning inventory. So if we start with our beginning inventory, which is 0, we add in our purchases, which in this case was 60, which you can see from over here. So that gives us 60 units available for sale. So I'll just abbreviate that as AVS. We then subtract out our ending inventory, which in this instance was 30, which we got from right over here. So this is my ending inventory. So that gives me 30 units that were sold. So now, under the LIFO method, using the periodic system, periodic meaning we go in and do a physical count of inventory at week end, month end, quarter end, year end, whatever you decide. But in this instance, it was actually month end. So under the LIFO method, last in, first out, we start pulling from our newest bucket first, and that newest bucket happens to be our March 28th. So if we sold 30 units and we only have 20 in our March 28th bucket, we need to actually decrease or take away that full amount from this bucket. So we sold 30, we already took away 20. That means that we have 10 units left that we have to pull from our next newest bucket, which is our March 15th bucket. So we start with 15, we subtract out that remaining 10. That leaves us with 5 units of inventory in that March 15th bucket. So if we look at our cost of goods sold calculation here, we sold 20 units at $3. 20 units times 3 for 60. We also sold 10 units at $2 a unit. So we have $10 times $2 a unit. So that equals 20. So our cost of goods sold is 80. So if we look at our ending inventory now, we can see that we have 5 units here, 15 units here, and 10 units here. So if we start with our first bucket, we have 10 units, March 1st at $1 a unit. That's valued at $10. We go to our March 10th bucket, we have 15 units at $2 a unit. That's 30. And then we have 5 left here because we took away that 10 at $2 a unit. So we have 5 times 2 for 10 for a grand total of $50 and ending inventory. So we don't have any units left in this March 28th bucket because we sold them all. So our cost of goods sold under the perpetual or using the periodic inventory system is 80 and our ending inventory is 50. So now let's take a look at a problem using the perpetual inventory system. So same facts, except that now we have the specific dates that some of these items were actually sold. And under the perpetual inventory system, we actually update inventory in real time. So as a piece of inventory is sold, the inventory number is automatically updated, as is our cost of goods sold, as is our purchases, or I'm sorry, not our purchases account, but inventory and cost of goods sold are updated in real time. So our first sale on March 2nd, we sold 5 units. So March 2nd falls between this March 1st bucket and this March 10th bucket. So actually, the items sold on March 2nd, we start pulling from this March 1st bucket because we haven't actually purchased these yet. So we need to deduct out our 5 units from our March 1st bucket. So our next sale on March 11th, which falls between this March 10th bucket and this March 15th bucket, we sold 10 units. Well, this hasn't happened yet. We haven't actually purchased these items yet, but we have purchased these. So this is our next newest bucket. Or our newest bucket that we actually just purchased. So what we can do is we now need to take those 10 units from this bucket. We don't actually start pulling from this bucket because that's older, and that would, if we were going to start pulling from that bucket, that would be under the FIFO inventory method, so the first in, first out. But in this case, since we're doing the LIFO method, we start pulling from the newest bucket first. So next, on March 16th, we sold 10 units. So March 16th falls between this March 15th bucket and this March 28th bucket. So we sold 10 units from here because this is our newest bucket. And that leaves us with 5. Now we sold 5 units on March 29th, which falls out here. So the March 28th bucket is now our newest bucket. So we need to deduct 5 units from this bucket. So let's take a look at our cost of goods sold here. So under our cost of goods sold, we sold 5 units at $1 a unit. We sold 10 at $2 a unit. We sold 10 at $2 a unit. And we sold 5 at $3 a unit. So our cost of goods sold under the perpetual inventory system is 60. Now if we look at our ending inventory, we have 5 units left here at $1 each. So 5 times 1 equals 5. We have 5 units left at $2. We have 5 units left at $2. And we have 15 units left at $3. So our ending inventory under the Perpetual inventory system is $70. So we can see that under the periodic inventory system, our cost of goods sold was 60, our ending inventory was 70. And if we go back up to see what we got for the periodic, we have a cost of goods sold of 80, and we have an ending inventory of 50. So you can see that each method, we come up with the same amount if we total up our cost of goods sold and our ending inventory, but the allocation between cost of goods sold and ending inventory is different because of how the inventory is actually sold and counted under the periodic and perpetual system. So perpetual, remember, it's updated in real time. So as an item is sold, inventory and cost of goods sold is updated, versus the under the periodic system, we don't actually know how much is left in inventory until we actually go in and do a physical count. So that's the LIFO method and calculating cost of goods sold and ending inventory under both the periodic and perpetual inventory systems. Hopefully that helped. If you have any questions, don't hesitate in reaching out to me. Thanks for watching.